I think it's very sad the way people act. You know, you have a guy in there that with the stroke of a pen could lower interest rates and save us hundreds of billions of dollars a year.
That there's going to be a retest of the lows. They're absolutely wrong. And Charles, this is going to feel like the back half of 09 or the back half of 2020, where you're going to have people rushing and reaching for performance. It's going to get crazy in the back half of the year.
Breaking news as mortgage giant Fannie Mae issues a warning that residential mortgage rates are naturally going to skyrocket, reversing their original expectations that mortgage rates would be and stay in the 5% range throughout this year of 2025. Now, they go on to explain that they didn't expect mortgage rates to go up at the same time that the Federal Reserve lowered the federal funds rate. But the big question is, why? Why did our consumer rates go up at the same time that the federal funds rate, or what I like to call the banker's rate, go down? Well, we're going to answer that question. And on top of that, we're also going to remind you guys what the current administration is saying that they want to do, which is even more quantitative easing by purchasing the 10-year Treasury to artificially drive interest rates down. And I want to be clear. I believe, in my opinion, that it's a high probability that we're in this situation because they already artificially lowered interest rates and for far too long. But before we go into this, happy Sunday, Mitch Vexler, sir. How are you today?
Well, the temperatures here in Texas are getting a little toasty. Other than that, it's kind of like the economy. Things are not so good and they're getting toasty in the wrong direction for most mom and pop, and we're going to explain why in a few minutes.
Fannie Mae predicts critical mortgage rate changes are coming. Economists and housing experts expected mortgage rates to follow suit and drop as interest rates decrease, and they're talking about the federal funds rate. But they're saying economic uncertainty, volatile financial markets, and precarious political climate have kept rates high. So they're not talking about the debt. Initial projections suggested mortgage rates could dip below 6% by the end of 2025. So that's what they thought. However, housing market sentiment and mortgage rate expectations have fluctuated this year, prompting Fannie Mae to revise its projections several times. So I highlighted that because they did not flip because of math, even though the math tells us what's going to happen next. Although mortgage rates were expected to steadily decline, shifting Fed policy, stubborn inflation, trade wars, wavering housing sentiment, and broader market unpredictability have put upward pressure on rates again.
Today, Jay Powell says something to me that either made me feel he's disconnected from what's going on or the ghost of Arthur Burns is riding on his shoulder, right? So he talked about inflation. You know, you want to approach carefully in a world where inflation is not back to 2%, and that's our job. If we make a mistake here, people will pay a benefit. It will pay and people will pay a cost for a long time. So, you know, he's talking about making mistakes and the average person paying a cost. Well, today we got May new home sales. They were a disaster, down almost 14%. And that's way below consensus, the worst since June of 2022. People are tapping their 401ks like never before. It feels like the Fed may have already made this mistake and it's already costing people. I mean, so when does the Fed realize this?
I think they're trying to save face. I mean, I watched Powell today and yesterday, and it's absolutely, it's an embarrassment to see how the Fed has devolved into where we are right now. Look, tariffs aren't inflationary. You take out shelter, which is lagging. You have inflation below target. Unemployment is starting to rise, but yet it's okay. We're going to have an economy that is going to slow, but we're not going to go into a recession. So, the Fed needs to get to neutral. I think they got head faked by the Biden administration and they got burned. And I think they're fearful of an inflation spiral, right. And I think they're absolutely wrong.
Jerome Powell and the Federal Reserve lowered the federal funds rate around the end of August. You guys can see the federal funds rate going down right here. And this is the one-year outlook. You guys can see federal funds effective rate. Now, when we look at residential mortgage rates, yes, they went down slightly at first, but as they continue to drop the federal funds rate, look at what happens to residential mortgage rates. And I'm showing you guys that because the federal funds rate is not directly directly tied to residential mortgage rates. This is right here, which is the 10-year Treasury. And as you guys can see, this kind of has a similar pattern as residential mortgage rates, where they kind of go down at first and then they go up and they stay up. Mitch, can you explain to the viewers why residential mortgage rates went up at the same time as the federal funds rate went down? What happened, sir?
I want to take a step back to answer that question. So quantitative easing equals printing of money, and that creates inflation. Quantitative tightening equals raising interest rates, which resulted in supply shocks. The inflation hasn't gone away as a result of the quantitative easing. New home sales have tanked. Home sales prices are coming down. Unemployment is rising. Retail sales are down. The Fed just stated a couple days ago, quote, labor market deteriorating noticeably, end quote. 47% more job cuts in May of 2025 as compared to May of 2024. It is 100% about the debt. And until the debt is properly dealt with, there is a higher probability of a greater depression. Every day that goes by and they don't deal with this, the odds increase. That's how the math works. So the reason that mortgage rates rise, even though, as President Trump would like to achieve, is bring them down 200 basis points, the bottom line is it may not work, and it certainly won't work for the banks. So what just happened in the last 3 years? Interest rates went up, the banks made more money, but why are they making more money and why are the interest rates going up? Well, it's in effect because the risk is going up. So banks have to charge more. Investors are going to want more because there's going to be more risk in the system. So as I said, the Federal Reserve can drop the interest rates 200 basis points. It's not going to do anything. You look at it on a short-term basis, okay, maybe it'll move the needle. On a long-term basis, due to the risk, no way. Are you going to put your money inside of a CD and end up with 0% rate of return or 1.5% rate of return? You're not going to do it because the banks themselves are the risk. So that's the answer to Travis's question. That's why mortgage rates are going to go up, not down.
Mitch, speaking of risk, what do you think will happen, say, if Japan, who is the largest holder of our debt, a treasury is the US's debt, they go into recession, China goes into recession, Europe goes into recession, and in order for those countries to get liquidity, they're now forced to sell the 10-year treasury. They're now forced to sell American debt so they have liquidity in their own economy. What impact do you think other countries can have on residential mortgage rates as the recession, the global recession, plays out? How likely is it that those countries alone will cause rates to go up? And then again, at the end of the video, we'll talk about what the administration plans on doing about it, which is not good. But how much of an impact are foreign countries going to have on our residential mortgage rates?
It's the exact opposite of what you're thinking. So watch this for a second. This is a game of musical chairs. And it's unfortunately become a polluted geopolitical game. So the US could, if China decides that China wants to invade Taiwan, the US could cut China off of the SWIFT program. Well, then China would have a very severe problem, much worse than they've got now. They've got a big problem. Their economy is also tanking. Their gross domestic product to debt is about 300%. Well, if the US government threatens China with, we're going to cut you off of the SWIFT system, China's got a super huge problem. Now, so do we. China holds 4.7 trillion in our US treasuries. And then, of course, they've taken that money and they levered it up. But let's leave that alone for a second. So then China would say, okay, then what are you going to do about it? And we would say, well, A, we're not going to pay you. We're not going to honor the 4.7 trillion in US treasuries. We're going to cut you off of SWIFT. De facto, China goes bankrupt immediately. It would be no joke because nobody wants the Chinese renminbi and as part of a trade agreement. So China would be in a world of hurt. It doesn't do good for the US government because we lose even more credibility. And the reality is that the game will stop. So the US could turn around at that point and say, fine, we'll buy all these treasuries back. Maybe they get them at less than face dollar, but that's a de facto default. So none of this is good. And the problem is it's all tied to the debt. China went out, they used our US treasuries and they levered them up into whatever they're going to use them for because it's same as cash. Well, okay, fine. So we'll lever those 20 to 1 and we'll go build ghost cities that nobody's occupying. It's happening everywhere. The theories of the Federal Reserve, the IMF, the European Union, all this nonsense got spread around the globe. The cancer is the debt. And like I said, until this debt is dealt with, and simply it can be dealt with very quickly. The problem is nobody wants to do it. And what President Trump is doing, I understand this bill. I read it from top to bottom. I get it. Problem is it doesn't work. It's going to kick the can down the road. It's going to create more debt. Now, the theory behind it is, well, it'll give us time to react to start to bring the debts down. Here's the problem. Nobody's talking about bringing the debts down. So these banks are in trouble, courtesy of the Federal Reserve, because the Federal Reserve, since its day of its initialization, has literally been there to backstop the banks. It does not exist for the benefit of mom and pop. It exists for the benefit to keep bankrupt banks in business. And therein lies the problem. The debt gets bigger. Those banks have caused, let's call it, for the sake of conversation between friends, 600 trillion worth of derivatives. Until you start whacking these derivatives and simply say, that's it, you got 3 years, unwind this crap, nobody, including the Federal Reserve, has a clear picture as to what's going on. So the Federal Reserve and the central appraisal districts or the school districts, which own the central appraisal districts, the two of them are the largest purveyors of fraud on the planet. They are the largest purveyors of inflation on the planet. Inflation is a fraud because the inflation was created, which is the form of debt, and in reality is a hidden tax. The Federal Reserve is guilty, the school districts are guilty, and the school districts own the central appraisal districts.
Another person's guilty, or an entity, which is Fannie Mae. Fannie Mae is also guilty, and what we've tried to do is show our viewers that Fannie Mae is just the long arm of the Federal Reserve. Literally, you can argue that the Federal Reserve, through their mortgage-backed security asset holdings, owns Fannie Mae. In fact, they're still in conservatorship. Fannie Mae is the long arm of the Federal Reserve. Comment below if you disagree or if you agree with me or just what your thoughts are overall. But I'm going to go back into this article and let's take a look at why they got it wrong. And I want you guys to remember the Federal Reserve has something like 24,000 employees. 24,000 employees that are supposed to be master geniuses got it wrong. Through 2025 and 2026, mortgage rate predictions remained fluid. Even, and this is important, a lot of people kind of got this wrong, but even a modest drop in mortgage rates could be enough of a spark to reignite a tepid housing market. Now, I do agree that if, for example, interest rates got down to 5.5%, that yeah, there would be a slight and temporary surge in buying activity. I say temporary because, again, we still have the problem with the prices. I mean, the solution here, other than the Fed, the CADs, Fannie Mae, getting rid of all of them, the solution here is deflation. Is prices going down. That's literally the solution here for you and I. 2025 and 2026 mortgage rates will be higher than previously expected. Last month, Fannie Mae revised its mortgage rate forecast, anticipating rates reaching just over 6% by the end of 2025 and dipping to, and this is what they're saying, 5.8% all the way to the end of 2026. So if you purchase real estate trying to date the rate, guess what? You're now married and strapped down by that interest rate. You cannot divorce that interest rate unless through bankruptcy or foreclosure or even a short sale. I say that because odds are you don't have equity if you have a high interest rate. If you have a low interest rate, you probably have some equity. And it's a fake artificial equity, by the way. The rise in housing inventory and improved economic growth influenced the optimistic housing market projections. However, rising 10-year Treasury yields, continued economic uncertainty, and mounting geopolitical tensions have kept mortgage rates elevated, preventing any progress toward the projected 6% interest rate. Adjusting for these heightened conditions, Fannie Mae revised its mortgage rate forecast upward, predicting average rates of 6.5%, ouch, by the end of 2025 and 6.1% 1%, listen to this, by the end of 2026. So they're saying you ain't going to get into 5% until the earliest 2027. That is a big flip-flop from Fannie Mae, by the way. This marks a significant jump from last month's projections that rates would fall to 6.1 and 5.8% over the next 2 years. So let's listen real quick to what President Donald Trump wants to do to Jerome Powell, and then we'll take a look and we'll talk about what he wants to do about the 10-year Treasury. Listen to this.
Look, if you were there, you'd say, well, you know, the United States is doing well. They have no inflation. And if they do get inflation in a year or two, we'll start raising the rates. We'll get rid of the inflation, and do other things. Biden had the worst inflation in the history of our country, 19%, but I think it was much higher than that. Frankly, they say 19%. I think it's a lot higher than that. And we have almost no inflation now. We've done a great job in a short period of time. Energy prices are way down. Gasoline now is down to close to $2 in a lot of places. A couple of places I see it even broke. It's like $1.98 a gallon. We've done a great job on inflation and honestly, pretty much everything else. I think it's very sad the way people act. You have a guy in there that with the stroke of a pen could lower interest rates and save us hundreds of billions of dollars a year. But he's a stupid person. It's very interesting. I'm not sure if he doesn't understand it, because you should be able to understand it. It's sort of 101 economics, but I'm not sure of that. But think of it, with the stroke of a pen, he talks about costs. We can save $600 billion. Maybe even, these are nice numbers for you, right? $900 billion, $950 billion by lowering interest rates. And it's really just more of a paper movement. It's not like you're not cutting anything. You're not cutting jobs. It's just interest rates. And we're number 40 or 44, number 45. Some places that you wouldn't believe that, I don't want to be disparaging, but they pay a lower interest rate than the United States of America. And without us, everything blows up. We sort of control the world in that sense. But we have a guy that's just a stubborn mule and a stupid person that is making a big mistake. He's making a mistake. And it lasts for years, because when you do the debt, now I've instructed my people not to do any debt beyond 9 months or so. Get this guy out. And whoever is in there will lower rates. If I think somebody's going to keep the rates where they are or whatever, I'm not going to put them in. I'm going to put somebody that wants to cut rates. There are a lot of them out there.
President Donald Trump is wanting to get a Federal Reserve chairman that is going to encourage all of the other board members to start to cut interest rates. But my question, Mitch, is, that's kind of a form of QE. I'm going to go into another article that's going to talk about they also want to drive down rates by purchasing the 10-year. I'll get into that. But won't QE just cause more inflation? And isn't inflation why we're even in this mess? So I don't understand, why would this time be any different?
It won't be. First of all, it's under the assumption that they're going to be successful in reducing the interest rates down to 2% or 2.5%. They can do it. But the reality is, it doesn't mean that the market, if you go and look at the bond charts, the market is telling you something completely different. Interest rates have been going up while the Fed has been saying we're probably at some point going to lower interest rates. The problem with all of this is what we are hearing and what is coming out of the White House and what is coming from the talking heads. I do understand the White House. I get this. I understand where they're going. But it's like a half-baked statement. This is what they want to achieve, but nobody wants to talk about the debt. So as that video was playing, I brought up my compound interest calculator specific to Frisco, but Frisco is a microcosm in this case for the rest of the United States, Frisco, Texas. The outstanding bond debt in Frisco today is $4,637,000,000. So that debt service per house that every house has to pay per month to service that $4,637,000,000 divided by 74,000 houses is $334 a month. That is what has to be paid just to service that outstanding fraudulent school district bond debt. Now, here's the big kahuna. In 30 years from now, that $3,34 per month payment grows to $3,768. The $4,637,000,000 grows to $52,613,000,000. Now, remember what I said. This is the microcosm for the balance of the United States. This is at the school district level, but the math is the math. The compound cumulative interest rate on the outstanding U.S. national debt does the exact same thing according to the rule of 72. So when somebody says we're going to bring these interest rates down for this short period of time, it literally means nothing when you compare it 30 years out. And that's the problem. There is not enough money today to replace the fraudulent debt that the Federal Reserve has created. They have printed 26 trillion in the last 4 years. There's not enough money. There's no income to pay it down. There has to be a principal reduction or the system blows to shreds. There must be a walk down, workout, call it whatever you want, of the fraudulent school district bond debt, or the system will mathematically, quantitatively implode because nobody on this planet can get blood out of a stone.
I guess this time isn't different. Now, I want to reverse the space-time continuum for a second here, Mitch, and I want to go back to February because I want to talk about something that concerns me, which is quantitative easing and the Federal Reserve and the federal government purchasing the 10-year Treasury. Take a look at this. The White House will take surprising approach to curb mortgage rates. And this is going to go into the fact that Scott Bessent and Donald Trump want to put a program together to start purchasing the 10-year Treasury, because as you guys know, and we've gone over, mortgage rates are closely linked to the 10-year Treasury yield. The 10-year Treasury yield is more influential in shaping mortgage rates than the federal funds rate, exactly what we've learned on this video. Treasury yields are the interest rate the federal government pays to borrow money over different periods. The 10-year Treasury yield is the interest rate for the 10-year Treasury bonds. Lenders set mortgage rates within 2 to 3% of the 10-year Treasury yield to make mortgage-backed securities more appealing to investors. The higher the Treasury yield, the higher the mortgage interest rate. High 10-year Treasury yields can indicate high investor confidence in the economy, but that can also indicate rising inflation expectations. Improving housing market conditions have been highlighted as a key priority, but it will be difficult to undo the market gridlock and lower interest rates without lowering the Treasury yield. The president wants to lower interest rates, and he and I are focused on the 10-year Treasury. He is not calling for the Fed to lower interest rates. He believes that if we deregulate the economy, if we get energy down, then rates will take care of themselves and the dollar will take care of itself. Inflation may be a key factor in driving down Treasury yields. As of February 10th, the 10-year Treasury yield stands at 4.51%. Right now, it's a little bit lower than that. Experts note that the Treasury Department is focused on keeping the yield from crossing the 5% threshold. I wonder how they plan on doing that. Do you guys think that the way that they plan on doing that is by purchasing the 10-year? Because remember, when people purchase the 10-year, it goes down. When people sell the 10-year, it goes up. It's the opposite of the stock market. We don't control long-term rates. That's interesting. What drives long rates is complicated and linked to things like the Treasury debt issuance. I guess I should probably start talking about that debt. Market expectations of inflation and global economic condition. I wonder if they're doing this on purpose. In other words, I wonder if they're devaluing the dollar on purpose and making this such a global systemic risk because they want to roll in some new type of currency system, whether it be crypto or a new collateral or gold-backed currency. I don't know. But it seems to me, Mitch, that is absolutely impossible for them to ignore the debt unless they want to ignore the debt. A child knows if you have debt, you got to pay it off. So not for 1 second do I believe they don't know that there's a problem. And they know exactly what the problem is. So my question to you is, are they devaluing the dollar on purpose? And if you believe that they are doing it on purpose, do you think it's possible that they're doing it on purpose to create a new currency system?
It's a very difficult question to answer. I will tell you this. The dollar is based on the US credit, meaning that you believe the dollar in your pocket is going to buy you $1 worth of goods. The SWIFT system across the globe ensures that trade from one country to another can occur. If you devalue the US dollar, let's call it to a certain point, let's not define a certain point, but the point is, if the public believes that the US dollar is disintegrating and the countries that use the SWIFT system believe that the US dollar is disintegrating, the law of unintended consequences means that the pendulum will swing way too far to the left. The US dollar and the US government loses all credibility, at which point the system that has been talked about through the BRICS kicks into gear. The US government has de facto done the heavy lifting for that currency, whatever that form happens to take, if it's backed by 40% gold, whatever, to take off. So they have to dance a very fine razor blade. The interest rates are all connected to this. The reverse repo at the Federal Reserve is connected to this. And just to explain to everybody how bad this debt is, to make it so that you can understand it one-on-one, do you realize that 40% of the value of a house today, which ends up in a mortgage-backed security, is devalued just simply to get back to where we were 5 years ago? That's how much the value of these houses have gone up. Well, when the banks take these mortgages, that means that those mortgages that were bought in the last 5 years that the banks are in bed with, they created them, they allow those mortgages to be sold at those fixed interest rates. Well, that means that they get a 40% haircut. So again, I understand what everybody is trying to do, but can you imagine, which is basically punt long enough that the economy will fix itself or some other issue will raise its head, and trying to get the debt to go away. I get it, but the reality is it isn't going to work. So unless somebody says we're going to do what President Trump wants to do, but simultaneously we're going to start paying down these debts in the following manner, that's how you get credibility. By ignoring the debts, you've got no credibility. These countries across the world are eventually going to say, sorry, US has no credibility. US government's going to say, yeah, we're not going to give you back the 4.7 trillion. We're not going to exchange them. And the whole system blows to shreds. But look at it for the long term. What would that do to the United States as a country, or any country? Because they're all in it. Canada's in it too. Canada's got the loonie. And last week it imploded. So there's problems everywhere. And the only reason these problems exist is because they refuse to deal with the debt. And the debt that they created is a fraud. Therefore, deal with it and get the credibility back and simply say, yes, we're going to do this. This is going to take time. But over here, we're going to deal with the debt effective immediately. We're going to start slicing by the trillions, not the billions.
So, Mitch, but they're ignoring the debt.
Yeah.
So because we know they're ignoring the debt, I mean, we just listened to a couple of videos. Do you think that there's some, I got to be careful how I say this, right? But like some secret force of obliques that they want to cripple the dollar. They want a new currency because they have already seen this coming for the last decade, and they're in a position now to take advantage of it. I mean, it seems likely that that's what's happening. I mean, look at history. So do you think this is on purpose? Do you think that there's someone in control? Maybe we don't know who that person is, Rothschild. Is there someone in control that wants the government to keep us like this?
The world runs off the SWIFT system. International trade runs off the SWIFT system. Trade runs off the US dollar. If somebody is trying to undercut and undermine the US dollar and the US government for that matter, that is called sedition and or treason. If they're being paid by an outside country and they're an American citizen, that is straight up treason. If that is happening, jail, and if it's treason, penalty is death. So undercutting the US dollar, undercutting the SWIFT system, one of the things that is so important is that we are the world's reserve currency. Like it or not, for good, for bad. That is the way that it is. And the fact that we are the world's reserve currency is important for the world because that allows trade. Whether we get into trade wars, trade tariffs, arguments, call it whatever you want, those things over time get resolved. But what cannot get resolved is the ability of a country as big as China is, it behooves them to ensure that the US dollar and its reserve currency status stay that way unless they intend to get out of it. That's a different topic, which is why they're buying gold and silver. But the point of the matter is, this is where we are today, and saying, well, we're going to devalue our currency. That doesn't do the world. That doesn't do mom and pop. That doesn't do the US government. That doesn't do anybody any good. It's a one-way ticket into hell.
Well, but yet we sit here with the debt, yet we sit here with the deficit. And Mitch, you of all people have shown me the math, and the math says that there is someone that has either designed this mess or that is facilitating this mess.
The fact that they are ignoring the debt could be seen as sedition because it's hurting the US government. Yes, that's true, but it's also an internal problem because the reverse repo, which is the responsibility of the Federal Reserve, you had mentioned before the mortgage-backed securities. Well, the mortgage-backed securities that come from the banks go from the banks. Federal Reserve says, you, the bank, give us your mortgage-backed securities and the crap that you created, and we're going to give you US Treasuries because our US Treasuries are worth more than your mortgage-backed securities, but your mortgage-backed securities, we'll take them at face value. Well, that's a fraud. Why? Because the value of those mortgage-backed securities, as I just said, to get back to 5 years ago, is 40% less. Therefore, the Federal Reserve accepted paper that is legitimately worth 40% less in exchange for 100 cents on the dollar US Treasuries. That's the connection between the mortgage-backed securities, the banks, and the Federal Reserve. As I said, the Federal Reserve is the largest purveyor of fraud on the planet, followed by the central appraisal districts and the school districts.
Okay.
The reality is that they've got to simultaneously, on both ends of this, somebody in the government's got to stand up and say, we are going to create a workout of debt without having to put all these entities in bankruptcy. We're just going to start slicing with the help of the Trump administration, because that's the only way this is going to get done.
Let me ask this a different way. So we're aware, the viewers should be aware through the math and hours and days and months of work, that we got a systemic fraud problem. It's
And a math problem.
I mean, it's a spider web leading to one rabbit hole to the next rabbit hole full of fraud, corruption, lies, the lack of transparency. We get that. But specifically, my question is this, specifically, do you think that is more of a result of stupidity or intent to defraud?
No, it's not stupidity. I mean, there are a lot of people that work for the government that are completely clueless. Is it intent to defraud? Yes, because the Federal Reserve itself is designed to defraud. When you take a bank and you say, I'm going to support the existence of this bank, regardless of how much profit it has, price to earnings ratio and or net cash flow to the bottom line, what's called free cash flow. And you say, well, it doesn't matter if it's negative free cash flow and it's negative net operating income, we're going to support this bank. Well, that's a fraud. That's defrauding because you're creating an expense on the back of the taxpayers. That is a fraud. It cannot be paid off. Those particular banks that participated in that level of fraud are bankrupt. They should have taken bankruptcy. The Federal Reserve should never have supported them.
So it's fair to say a lot of it is intent. I'm going to get the viewers out of here, Mitch, and I just wanted to throw this out here as a couple solutions. Okay, obviously one of them is solution in prices. Deflation, okay, not inflation going down a little bit, deflation, prices going down. And also a really, really important solution is you guys fight tooth and nail to maintain to the best of your ability your purchasing power. Because it's not good for America if we have price decline, but you guys can't take advantage of the lower prices. We don't want those lower prices getting into the hands of a leveraged up banking sector. We don't want that. We want you guys to be homeowners that are comfortable, that are living the American dream. So that's what we're hoping. If you guys want to join the movement, you can go to realestatemindset.org. You can learn about how to end property taxes, how to purchase real estate. You can go to mockingbirdproperties.com. That's Mitch's website. If you're in the battle for property taxes, either way, we plan on holding your guys' hand to the finish line. And other than that, I hope you guys have a good Sunday. We'll see you guys again on Monday. And if you guys are out there investing in your lives, yourself, your relationships, you guys already know we wish you luck. And we hope you win.